As an advisor, I'm often asked, what is the better option, ISA or pension? Well, ideally you would want both, but if you have to pick one, the pension edges the ISA. And here's why. For the purposes of this, let's simplify both. Think of an ISA and a pension as just a box. It's a tax shelter. So here's the ISA box. You can put money into it. Any money that you put into the ISA box either just sits in cash, in which case it earns some interest, or within that box you can invest the money into stocks and shares in order to grow the money a bit faster. Regardless, it's free of tax. So if it's in cash, it's free of interest tax. If it's in stocks and shares, it's free of capital gains tax, dividend tax, interest tax. But whatever money you put in is the only money that goes into it. And when you take money back out, there's no tax. ISAs are probably the simplest form of tax avoidance, bearing in mind that tax avoidance is a legitimate way to pay less tax, not to be confused with tax evasion, which is an illegal way to do that. Now, I once had a client say, I don't believe in pensions, like they're UFOs or something. I don't really understand this, and I'll explain why. So, often when people don't like pensions, what is cited is that you've got money in a pension, and that money you take out of it at the other end is subject to income tax. But that misses a huge amount of context. So, back to the box idea. Okay, so the second box. Now, the important thing to note is that when you put money in, so does the government. The government is giving a massive amount of money away for free to those who put money into pensions. And if you're not putting money into pensions, you're not getting any of that money. Government contributes so much to our pensions that it's a massive cost to the Treasury. About £30 billion a year is spent on pension tax relief. So you've got your pension box. I'll use simple numbers to show how this works. When you contribute into that box, the government will contribute as well up to your tax rate. So if you're a basic rate taxpayer, they will add 20%. Now, in practice, they actually add 25%. And to explain why that works, it's because the net amount of the contribution, let's say you put £10 in net. Net means your contribution plus theirs. 20% of £10 is £2. So you put in 8 and they put in 2. So it works backwards, because if you were just putting in 8 and it was 20% of 8, that doesn't equal 2. So it grosses it up effectively. So that doesn't sound like a lot, but that means that when you put in 8,000, you get £2,000 for nothing. If you're a higher or additional rate taxpayer, it's even better. So as a starting point, you still just get the same contribution of 25% when you put money in. But through self-assessment, you can then reclaim the higher rate or additional rate tax back, which you get back as cash, and then you can do what you want with it. So you've put money into pension, the government's added money, and then you've had some money back on top of that. So you've got your two boxes. Now the ISA you can put £20,000 into a year, the pension up to £60,000. But you can only put in as much as you're earning. That's the relevant earnings rule. So if you're only earning £30,000 a year, you can only put £30,000 into a pension. So there are some limits to be aware of. But let's use an example. So your ISA and your pension box. You put £20,000 into each. The ISA still just has £20,000 in it because only you have contributed. Whereas the pension gets the government contribution and is grossed up to £25,000. So the starting points are totally different. Then you have some cash in both. Now that can be left as cash if you really wanted to, but normally what you would be doing is investing it, certainly in the pension, because pensions have a long time frame to the access point, which is currently 57 at the minimum. They are designed for long-term retirement. And that is one disadvantage, because the ISA can be accessed immediately. So if you think you need capital in the short term, you wouldn't use a pension. These are for long-term investments. So you've got your 25,000 in the pension and you've got your 20,000 in the ISA. And let's say you invest that money. Now in both, you can invest it in exactly the same way to achieve, say, the same growth rate. Now with both of them, you're not paying any tax as they grow. So as they produce income, dividends, there's no tax to declare on either. And over time, let's assume you're contributing more. So because of that, the pension is building into a much bigger value. It's invested in the same way, but you've got this contribution. So you're going to have a much bigger pot over time in the pension than you are in the ISA. And you can put more into it. Now, many years down the line, you decide to access them. Let's say you've retired, for example, and your income has stopped. And you're over 57. You can now access the pension. Now, the ISA's easy. The ISA's just, you take money out and there's no consequences. There's no tax consequences at all. You take it out and you spend it. The pension's slightly different. Now, in most cases, and most people will be aware of this fact, whatever the size of the pot, and remember the pot's going to be much bigger than the ISA because of all the government contributions, you can take 25% tax-free. So that is already a massive advantage because the pot's much bigger and you're getting 25% of it tax-free with all of that uplift on the way in. But even for the other 75%, that is only taxable within the normal income tax bands. So if you've stopped working, for example, you could draw your personal allowance out, 12,500, from that taxable portion and it would still be tax-free. So how you manage taking money out the other end is very important. But the fact remains you've had phenomenal value by all of those contributions and you can manage the tax on the way out. So pensions are more efficient. Another thing about pensions. So I'm referring to a personal pension that you make personal contributions to. But remember, if you are running your own business, you can make employer pension contributions to your pension. And that payment leaves your business and lands in your pension without deduction of income tax or national insurance. And it's also a deductible expense for the business. So it works really well if you're a business. The other major advantage is currently they are inheritance tax free. ISAs are included in your estate, pensions are not. But that is changing following the recent budget. Pensions will be in your estate from 2027. And what that means is potentially pension could be a bit less effective when it comes to death benefits, because it's fine if you die before 75 because currently the pension is a tax-free lump sum to the beneficiary. But after 75 it becomes taxable. Now if you throw inheritance tax into the mix as well, that means that pensions on death after 75 become a bit dramatically taxed. But for the purposes of your own life and using pensions for yourself in retirement, the pension edges the ISA.